There are many excellent ways you should invest this year, depending on your investing style and your objectives. Building wealth through investing is a long-term process that takes time. If you want to see results, you must be persistent and adopt appropriate attitude. There is no getting around the fact that you must also understand what you are doing. So, if this sounds like something that might interest you, then keep watching. Now is the time for you to start improving as an investor by learning from the investing guru's style. Welcome to the Finance Professor channel, your personal finance and wealth professor. Be sure to hit like and subscribe to my channel and press the bell icon to stay up to date on the most recent financial and wealth related news. So let's move on. Looking back 10 to 15 years ago, the financial markets had remarkable growth, where the stock market scored one of its best decades in nearly 140 years, specifically 10 years after the financial crisis bottom. Since then, the Standard & Poor's 500, or simply the S&P 500, has almost doubled and the price was more than tripled. The cheap money was indeed the major catalyst for this remarkable growth because during that period, the highest interest rate was 2.5%. As a result of having easier and cheaper access to money, businesses have made it easier also to expand, investors to make more money, and valuations to grow. It was then realized by the end of 2019 that whatever one buys, it doubles very quickly, and then comes the bubble bursting. But it was this time during the pandemic period. Therefore, the historic decade-long run came to an end. Due to this unexpected market shift, many investors began to lose interest and pull their funds out of the stock market. The COVID-19 pandemic caused great damage to the global economy. The world changed dramatically, and the great lockdowns caused the worst economic downturn across the globe. It significantly impacted many businesses, which caused them to shut down. It also led to financial markets collapse. The pandemic recession was catastrophic and brought the world economy to its knees. Central banks considered debt monetization, so governments across the world started printing money to help them cover some of their pandemic-related spendings. The US Federal Reserve also printed trillions of dollars and pumped up to $3 trillion, which ultimately flooded the economy through the forms of stimulus checks given to many households, financial bailout packages to businesses, etc. But apparently, the free money couldn't save US citizens. With this debt monetization, economic inflation rose sharply throughout 2022, with a 40-year high inflation rate in June. And now, US citizens are living with 4 decades of high inflation and have not seen prices soar so much since the early 1980s. Bloomberg News anchor Michael McKee reported this.
Year-over-year basis, when you're looking at where inflation is, we thought we could say it peaked last month. It did not. 8.6%. That matches the all-time high in this cycle, and the core rate up 6%.
Just as it can increase the money supply by printing money, the Federal Reserve can also reduce it by making moves that increase interest rates. So after this money printing had caused inflation in the economy, the US Fed again stepped in and started raising the interest rate. The consequences of this action, however, are rather awful. The rise in interest rates has made it difficult for businesses and citizens to access money. Apparently, these desperate moves have even halted the economy run, with panic spreading to financial markets. For instance, the cryptocurrency market goes into a free fall, and many big names in the corporate world are struggling. The real estate sector is impacted by the decline, and the equity market is dropping as well. Major sell-offs can possibly be seen from investors who are triggered by fears that the world is on the verge of a terrible recession. So, is there a right market timing the investor should know when to enter the market? Is it when the markets are already at their peak or when the stocks go on sale? In the world of investing, it is well known that market crashes, which typically happen after a long period, are the best opportunity for wealth creation. Therefore, no one can say with certainty that people will experience another period in their lives during which everything will be discounted. Investors have historically done well to purchase at discounts during the time following any correction or crash. Is now the ideal time to increase your wealth though? Let's get to the bottom of the question of whether this is the right opportunity, and if so, how can one make the most of this moment? In an interview, Warren Buffett stated,
"Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things, because a stock goes down, you shouldn't own a stock at all.
The psychology behind investing is complex. The basic principle of investing is to buy low and sell high. But people actually act in the exact opposite way. They buy high and then sell low. In spite of their best intentions, people tend to leave the markets during hard times because uncertainty and fear terrify them. But experts like the venerable Warren Buffett, Charlie Munger, Monish Pabrai, Guy Spear, Phil Town, and many others contend that investing is best done when the market is severely down. The phenomenon described here is intriguing. The majority of people don't seem to have specific investment goals, which is the main cause of this backward psychology. They typically don't commit to a long-term investment time horizon. As a result, when times are tough and a recession occurs, instead of seizing the chance, people flee the temporary chaos, which is a terrible tactic. On CNBC News, Warren Buffett stated,
"We're a net buyer of stocks over time, and who wouldn't rather buy it, at a lower price at a higher price?" People are really strange on that. I mean, because most of your listeners are savers, and they should want the stock market to go down. They should want to buy at a lower price, but they have that feeling that they just feel better when stocks are going up.
Let's examine the U.S. historical bull and bear markets since 1926. Bull markets are blue and bear markets are orange. You might think that recessions are unavoidable. It is clear that since 1926, the U.S. has experienced 11 bear markets and 15 recessions. The number of bear markets would increase to 12 if the pandemic crash of 2020 were included. In total, bear markets lasted 14.7 years on average, while bull markets persisted for 75.4 years. However, it is a fact that if you had made investments during these stressful times, you would have gotten good returns. For instance, returns coming out of the Great Depression were around 265% over 4.4 years. Then people made 43% in 1.8 years, 210% in 4.1 years, and over 900% in 14.8 years. And the trend goes on. People who invested in the biggest bear markets in recent history enjoyed 20 to 50% returns in a matter of 12 months only. For instance, profits after the Great Depression lasted for 4.4 years and were around 265%. Then as the trend continues, people made 43% in 1.8 years, 210% in 4.1 years, and over 900% in 14.8 years. Those who made investments during the biggest bear markets in recent memory saw returns of 20 to 50% in just a year. Although there is no ideal market in which to invest, these trends demonstrate that these bear markets do present excellent opportunities. For example, if you had made an investment at the peak right before the 2020 COVID outbreak, you would have made 9% on your money. On the other hand, you would have made 60% if you had invested at the market lows, which were a few weeks after the peak. This is how a difference-making entry point works. But keep in mind that there have only been 14.7 years of a bear market and 75.4 years of a bull market, so such significant drops are not common. So it can be said that recessions are excellent times to invest. But how do you take advantage of this chance without squandering it? Well, step 1. Keep up the pace with what's happening in the market so that you know exactly when these opportunities will be there. And step 2. Execute your strategy correctly, whether actively or passively, as soon as you see a recession in the market. Step 1 is to stay informed about market events so that you can anticipate when these opportunities will arise. Step 2 is to implement your strategy effectively, either actively or passively, as soon as you notice a market downturn. There are a few ways to invest for the long term. As we are all aware, dollar cost averaging or long-term value investing in the Warren Buffett fashion are the two options. The best way to accumulate wealth, according to investing experts like Warren Buffett An economist and author Benjamin Graham is to keep investments for the long term, a practice known as buy and hold investing. But nowadays, dollar cost averaging is preferred by most people. Now, let's explain dollar cost averaging to those who are unfamiliar. It involves taking the funds and distributing them among the stock market. It is accomplished by, for example, investing in index funds like the S&P 500 index fund, which is incidentally the biggest index fund in the world. As a result, they opt for the market tracking investment, and investors add the same sum to that market tracking investment fund on a regular basis. Your money will then be distributed among the entire market and can be as little as $2,000 twice a year or something similar. This strategy has been created to reward the market over the long term, which is typically 10% per year for the S&P 500. This strategy makes it appear as though you are not taking advantage of the market crash or timing the market, but you are. On October 9, 2007, for instance, $2,000 would have purchased 12.78 shares of SPY. However, $2,000 got you 20.5 shares a year later, as the market was about to decline. Simple that. When the price of equity is lower, you purchase more and less of it. Naturally, this is the case. Passive investors can take advantage of the opportunity the best this way. In addition, investors want more control over their portfolios, which leads them to adopt Warren Buffett's strategy of buying individual companies. They are aware of their competitive advantage, smart management, and higher price margins for safety. However, we won't be discussing this tactic. We'll see how proactive investors make sure they don't commit any errors when making investments in a volatile market. The first thing we need to figure out is why all of this is harming businesses. Currently, the issues are rising interest rates and inflation. This implies higher prices, lower consumer spending, and more expensive debt. How do we determine whether a business will survive in such circumstances is the current question. The business you're considering must possess pricing power. This indicates that they have attained a competitive position. They have the ability to raise prices without experiencing any decline in sales. For instance, many companies are lowering their prices as a result of consumers' decreased spending on luxuries. However, some companies like Coke are robust enough to raise prices without experiencing a decline in sales. With the increase in Coke's prices during an inflationary period, the consumers don't suffer because the cost can be passed on to them. Rising interest rates are the other factor. The price of debt increases as a result, among other things. You must therefore ensure that you have little debt if you want your business to function well during these times. For instance, Google has a debt-to-equity debt ratio of 0.5. Meaning that they have more cash than debt. Compared to what they pay, they make more interest. Even better than not having any debt at all is Meta. According to Peter Lynch, it becomes harder to go out of business if you owe little or nothing to anyone. The business model comes last, but certainly not least. You must determine which business model you are employing. Will it be able to survive an unstable economy? For instance, grocery stores. In recessions, these models perform better. This is due to the fact that people are unable to stop purchasing necessities like insurance policies and airline tickets. People can't stop using all of these things. Therefore, active investors must consider the business models, their pricing power, and their debt levels. For passive investors, on the other hand, it's all about hanging on for a long time and staying strong. Thank you for watching. Make sure to subscribe to the Finance Professor channel if you like the information in this video and want to get the best updates on the newest investment news and topics and their potential effects on stock prices.